surging global supply has led oil prices to drop to a more than a decade low. The collapse in prices has taken a heavy toll on Asian oil companies. In a rare move, the largest state-controlled oil producers of China and Malaysia have both announced they are cutting spending and production to cope with the low prices. Why is this happening? First, global oversupply. The world just has too much oil. Despite the low prices, many oil producers have refused to curb production because they want to protect the market share. As sanctions against Iran have been recently lifted, the Middle Eastern producer could add at least 500,000 barrels a day to the market. Second, global oil demand is slowing down. China is currently the second biggest oil consumer in the world. Analysts say as China moves away from a heavy industry-based economy to a more services-oriented one, the country's oil demand is also likely to slow down. The exceptionally warm winter in North America and in Europe is also hurting demand for oil. So, what are the implications? Cuts in jobs and capital spendings. Oil companies worldwide have been cutting their investment to keep their cash flow high. Malaysia's state-owned oil company Petronas said it will slash spending by as much as $11.4 billion in the next 4 years. China's state-controlled oil and gas producer CNOOC plans to cut capital expenditure by 44% from 2014. The company said its spending wouldn't exceed $9.12 billion this year, a sharp drop compared with previous years. Jobs are also getting cut elsewhere. BP says it will slash about 4,000 jobs over the next year or so. Chevron plans to cut 6,000 to 7,000 jobs, and Royal Dutch Shell at least 6,000 jobs. So will there be a rebound? With too much oil and little demand, a price rebound may still be some distance away. Goldman Sachs reckons prices could fall as low as $20 a barrel before producers will be willing to cut production. Morgan Stanley says the rapid appreciation of the US dollar could push oil prices down to around $20.